We've talked a lot about all the different kinds of costs, and we know how to calculate product cost. But how do all these costs flow through the company, and for what and when do we need to record them? Let's go back through our candle example. The customizable candle company makes candles that customers can order in varying sizes and colors and can specify the type of wax used as well as the fragrance. To begin production, we need to buy materials. We purchase all the wax and wicks and fragrance and everything we need to make the candles. The total of all our materials we purchase comes to $18,000. We would debit raw materials for $18,000. Let's assume we purchased these on account. Therefore, we would credit accounts payable for $18,000. In manufacturing, we have 3 inventory accounts. The first is raw materials. This is where it all starts. Before we begin making our product, all of the materials that we will need to make the product are here. Once we start working on a product, we take the materials out of raw materials and put them into the next inventory account called work in process. While we're working on the product, but it's not yet finished, all costs go here. Once the product is totally completed, we move all the costs into the third inventory account called finished goods inventory. They stay here until they're sold. Once sold, these costs move one more time to the account cost of goods sold. This last move transfers the cost from inventory and the balance sheet to expenses and the income statement. At the candle company, we start working on several candle orders. We get $14,000 of materials to begin making the candles. $13,100 are direct materials and $900 are indirect materials. The direct materials go on the job cost sheets and go into the work in process account. The indirect materials go to manufacturing overhead, also called factory overhead. We would debit work in process for $13,100, debit manufacturing overhead for $900, and credit raw materials for $14,000. We now need to take those raw materials and convert them into a finished product. Everything in between is part of work in process. We need labor to make the products. We need electricity to power the factory for the lights and equipment to make the products. We need water and toilet paper so everyone can use the bathroom while working throughout the day. We need to pay the supervisor and the cleaning crew. There are a lot of costs involved with making the product. Let's record the labor charges. We need to pay all of our employees. Our total salary and wages for this period is $10,500. Of that amount, $9,000 is for direct labor and $1,500 is for indirect labor. We would debit work in process for $9,000, debit manufacturing overhead for $1,500, and credit salaries and wages payable for $10,500. All of the other charges involved in making our product would be debited to manufacturing overhead. The light bill comes in, debit manufacturing overhead, and credit accounts payable. The lawn crew cuts the grass at the factory and you pay them the same day, debit manufacturing overhead and credit cash. Pay rent on the factory? You guessed it, debit manufacturing overhead and credit cash. All the overhead charges accumulate as debits to the overhead account as they happen or are incurred. They get applied to the products as they are made by using the predetermined overhead rate or rates. A company could use one single company-wide rate for all products, or they could use an overhead rate for each department. We'll keep it simple and assume one single company-wide rate. The candle company uses an allocation base of direct labor hours for their overhead rate. Their predetermined overhead rate is $28.15 per direct labor hour. Assume a total of 600 hours in direct labor for this period. We would apply a total of $16,890 in overhead for this period. We would debit work in process for $16,890 and credit manufacturing overhead for $16,890. By the end of this period, we have finished one of our orders. Hooray! It's our order of 2,000 lavender candles that we filled out the job cost sheet for in a previous example. Here's the cost summary for that particular job. All the costs shown have already been accumulated and recorded in work in process. We're done with this job, so now we want to move it out of work in process, since it's no longer in process and being worked on, and move it to finished goods inventory, since it's complete and ready to sell. We will increase finished goods inventory and decrease work in process. To do that, we will debit the total cost of this completed job to finished goods inventory, a total of $3,430.60, and credit this amount to work in process. The cost of completed jobs are called cost of goods manufactured. The only thing left is to sell those candles. Until they are sold, they, or rather their cost, will sit in finished goods inventory on our balance sheet. That's not earning us any income or getting us any cash, so we want them to go. Since this was a specific customer order, they all sell. But let's assume for the sake of our example that wasn't the case, and we only sold 1,500 of the 2,000 candles by the end of the period. That means 500 of them will stay in finished goods inventory. However, 1,500 of them need to be moved out of finished goods inventory. Each candle cost $1.72 to make. Remember, we figured that out on our job cost sheet. If we sold 1,500, then we would want to decrease finished goods by $2,580 and increase cost of goods sold by $2,580 to show the cost of the items that we sold. We would debit cost of goods sold and credit finished goods inventory. After all this time, those candles finally made it to the income statement.